Okay, so chapter 9, all right, is going to talk about cash, or more so this chapter here focuses primarily on petty cash, all right? Now we understand when we're dealing with cash, right? We have to understand, well, what is cash? Pretty straightforward, right? We live in the United States, so therefore our terms of cash is going to be the United States dollar, the US dollar, okay? So basically what cash does is it's a form of some kind of means to trade for a good or service. Pretty straightforward, right? We understand, especially when we exchange money to purchase our things and buy things, right? Now, we're just not only limited to just only cash, we also have checks, right? Any forms of money that's considered some kind of transference of dollar value that we can use to trade for a good or services is going to be, pretty straightforward, right? So cash is going to be definitely one of them, and it's the most easily readily available, right? Every store should have cash available, right? Especially because everybody uses cash or they use some form of credit to obtain a good or service, all right? And cash is the most readily available, right? It's the most widely used form of currency that is widely used not only here in the United States, but it's also used over in the foreign countries, right? It's our means to trade for a good or service, okay? So then we're going to talk about a check. A check is going to be one of the business's most widely used form of currency. Why? Is because it leaves some type of paper trail, right? The greatest thing about a check is that it gives you the person's name, right? It gives you the date of when you issued the check. It gives you the right amount, and most importantly, you have obviously your check number or your bank account number, or they normally call this as a routing number, and they have a paper trail or some kind of check number or some kind of order that you release your checks in. So this is a perfect way that most businesses, when they cut their checks, they keep track of their transactions exactly, and they also once they issue a check, their job is to make sure that that money gets taken out from their bank. All right, and this is a perfect way to keep track of your business transactions, okay? Especially if you are a huge corporation, right? You want to make sure that every check that you cut out, you're keeping track of everything that where your money goes and where it's being placed into, okay? Especially when you use cash, right? Cash, right? If you're using cash and you get change back, right? What happens to that change? Well, that easily can be put in your pocket, or that could easily go back to the company. But once again, when we're looking at actual physical cash, right, your only proof of a transaction is that you have a receipt, all right? But here, when we're actually taking a look at a check, it's actually, we get to see it from moving from one point A to point B, okay? And it's a perfect trail of proof that a transaction has happened, but also you get to see where your money is going, all right? Now, this is just a regular check, right? If you guys still use checks, well, this is a review for you guys, but for those who cease to use checks nowadays, right? Because a lot of nowadays, it's much easier to use a credit card, or cash would be more easier to use. Where a check, not so often do we use checks. But like I said, it's some form of paper trail for businesses to keep track of their money. Now, of course, in order to make a check valid, right, these are already pre-made types of currency, right? You can't just print these out, all right? They have to be on that special treasury type of paper that has that watermark or that seal on it. that says that this is a legitimate treasury type of check. All right. That's obviously number one, that you can't just print it on a plain piece of paper and say, here, this is a valid form of check. No, it has to be legal on a legal type of paper that is imprinted on prior to let you know that this is a legitimate treasury type of document. Second thing is that it gives you your information, so your business information with its address and everything, mailing address, and so on and so forth. And the most important thing is going to be your checking number or your routing number, okay? Because this is where, when they receive the check, when they deposit into their banks, this is the number that they're going to be taking the money out from directly, all right? Now, here are some components that you can have to do. You can't just send a blank check, because obviously that doesn't make a check valid, right? There are 5 components that you have to have, right? And the number one is going to be, well, who is going to be receiving the check? Who is the person you are paying, or who is the payee's, what's the payee's name, right? Who's going to be on the receiving end of this check, all right? Second thing is going to be the date that you're going to allow the check to be available. So oftentimes, right, a common one would be a paycheck, right? Most paychecks are pre-dated, as in they timestamp it saying that it's available on this date, okay? And that's exactly the same thing here, right? You never want to write your checks the same day that you send them out. You want to give your you want to obviously give the person some time, but also don't make it available for a specific amount of time, right? So sometimes paychecks, right, they could be released on Wednesday, on Thursday, right? But you can't cash it out until Friday. So that's a common feature, that the date is most important, is when is the cash available for you to take away from this check, all right? Third thing is going to be the amount. The amount is going to be obviously important, because you definitely want to make sure that you have enough money in your bank account before you can write out this check. So then you write out the amount. Now, safe way to safeguard your amounts too is that you don't want to walk around with $1,000 in your pocket. The best way to transfer money safely in large sums or large quantities is that you want to properly take it using a check. Now, a lot of checks, right? Some checks, they have certain certain numbers or certain amounts that you can write up to. But it depends on your business and depends on that. But it's important that you have enough money, but it's also one way to safeguard when you're sending thousands of dollars. You want to properly write it out in a check instead of walk around and have $1,000 in your pocket. That's definitely not safe. Anybody can, come after you. So this is one way to safeguard your money, is that you send a check. The third thing is that the last thing here, right? We already talked about the accounting number, right? Where is this money taken out from? The last thing that you have to do is you need to have a signature. You need someone to verify that this amount is correct and this is the person I'm going to pay. You need to have a signature, and usually it's the accountant, or it's the president, or it's whoever is managing the business itself, okay? So a signature is very important because it validates and lets the person who's receiving on the other end validate that this check is written out for this amount and that this transaction has been approved. All right. Now, there's a few things that you have to know about this. You obviously, if you write the person's name or the company's name, therefore it's very minimal way of frauding a specific person. Yes, you can intervene and somehow try to cash out the check, but if your identity does not match the name on the check, then obviously that's where you can get stuck there. for any reasons that you lose your check or for anything like that, you could always void it by going to your bank and saying, no, cancel the check. And this check would basically be nothing, just be a piece of paper. Okay, so there are a lot of safeguards using a check nowadays. It is safe because, you can limit the amount of fraud because the name must match the person that's receiving the check, and it has to match them in order for them to retrieve it on their side and their end. Okay. And of course, we have, nowadays that we're living in the digital age, right? The most widely used is going to be some form of credit card, okay? Credit card is the most easiest type of way. You don't need to carry your checkbook. You don't need to have cash on your hands. And your credit card is going to be either you can have a debit card that goes directly from your bank account, or you can, apply for a business credit card that allows you to borrow money and you just pay them back, right? So again, credit cards are an easy form of way of making purchases of some sort of good or services, right? And it's the most widely used, right? And once again, it's the easiest to use as well. A lot of companies nowadays, they use some sort of credit card system. Now, here's a little fun fact that you need to know if you are looking at some kind of standpoint where you are allowing your customers to charge on a credit card. All right, because on our end, it makes it so much easier if we're going to be the ones that's purchasing all these goods and services, right? We just swipe our card and we're good, right? And it's going to be considered a liability because this is money that is not ours. It's money that we're borrowing from these major credit card companies, right? Whether it's Citi, Chase, Bank, all those credit card companies, right? We're going to be owing them money, all right? And we're going to be charged a specific amount because our exchange, and when we sign that contract validating that we accept the terms, right? That every month we're going to receive a bill from them, and they're going to charge us a specific amount called interest, right? So on our end, it makes it so much easier. But let's say we are a retailer, right? And we're looking to make it easier for our customers to come into the store and charge on a credit card, right? That's where you need to work with these major credit card businesses. So not the bank itself. You're going to be working with Visa. You're going to be working with MasterCard, Discover, all right? These are the little logos that are on the bottom of the credit card. They are debt collecting companies, all right? And of course, we've seen it before. Visa and MasterCard are the widely used debt collecting types of companies, right? You need to work with them because what they are essentially doing is that they are collecting the money for you and giving you the money in advance. So therefore, if you are planning to have these credit cards companies be accessible for customers to charge at your store, you are subject to have to pay a specific percentage or a flat rate to these credit card companies. So you're not profiting 100%, you're only profiting maybe 95% or even 97%, depending on what your just terms are. Because what these major credit card companies are doing is they're giving you the cash in advance, and they're making sure that you receive the money that you sold to this person, okay? Because on their end, what they are doing is they're accepting that the customer is going to owe them. Meaning if they fall on their payment, they are going to be responsible for it, not you, okay? And ultimately, that's a huge trade-off, right? You're using these credit card companies to collect the debt for you, and you don't need to take care of anything, all right? You're not responsible to go after them and track them down and have them pay for you for whatever amount that they owe you. These credit card companies are going to handle that work for you, Okay, so there's obviously a price that comes to having someone else do the job for you. Okay, and that's just a little fun fact. So if you are running a business, a lot of small businesses, that's the reason why they rather do cash basis, because they need to earn every single penny that they've made, right? They can't afford to have these credit card companies run their, take a percentage of their sales, because it hurts their business overall at the end. But once again, because credit cards are so widely used, it sometimes hurts the business too. If you're running a cash business only, you can easily lose a potential customer, because you could say, sorry, cash only. That person that had a credit card could walk away and you would lose them as your customer. So there's a lot of benefits and a lot of downsides to having a credit card usage, whether you are using the credit card or whether you are allowing your customers to use credit cards, okay? And we'll dive more in depth on how these credit card charges actually works when we dive into QuickBooks. Okay? And of course, nowadays, with the vast majority of the easiest way to transfer money, right? We have Zelle, we have Cash App, we have Venmo, right? All of those are some type of way to easily electronically transfer money from your bank to another person's bank, right? This is going to be a common one, especially when you're dealing with the government. When you're trying to make payments to the government, they don't want a check. They don't want anything. They want you to directly transfer the money directly to their bank account by using an electronic funds transfer, okay? And we'll talk about that again in QuickBooks, because that's definitely more prevalent there. However, right, it does make business a lot easier, right? It keeps track of it because you have your bank information, right? You have your bank, your online banking app, or some form of way of connecting to your bank, right? You can easily transfer money or wire it. Back in the day, they called it wiring. You can easily wire transfer money from one bank account to another, okay? And nowadays, right, now with the vast majority of having it so easily available, right, they don't charge you no longer, right? It's free now to transfer money. Where back then, sometimes they would cost you a fee to wire a lump sum of money from one account to another, right? Sometimes there's a cap to it. But once again, nowadays, a lot of businesses, especially when, we live in the digital age, all we do is carry our phones around, right? We use Apple ID. We use, I don't know what Android uses, but similar idea, right? They use their phone that has their bank card information. They just tap it onto the cash register or their little credit card information, and essentially it's like you're digitally swiping your credit card. But in this case, what you're doing is you're transferring money to from your mobile banking account directly to that person's bank account. Makes it so much more easier. So EFT stands for electronic funds transfer. Once again, very commonly used, and it's perfect way to be able to go ahead and transfer money a lot more easily, right? So that's what happens when we live in the digital age. We're no longer using checks anymore. We're slowly not using credit cards anymore, and we're just using our phones, okay? So that's cash for you right there. Now, the main thing I want to talk about is, so that's the way that we can accept cash, right? Or in this case, right, these are the options that we can use to receive money from customers. And this is going to be very important, especially when we dive into chapter 10. And I want you to make sure that you guys understand what are your available options when it comes to either selling a product or you purchasing the products, okay? So now we're going to talk about petty cash, all right? Petty cash can be something that a business can or doesn't have to have, right? Petty cash is basically a small little lockbox drawer that you put money in there. And what it does here is that it basically allows you to have some kind of pot of money for you to go ahead and do place for minor expenses, okay? And for example, right, let's say we are a Photoshop or sorry, a photocopy center place, right? Our main sales is ink, right? Our printers, our ink and paper, right? If we run out of something, and usually what you do is you properly do a purchase order to order those items so we can receive those items later on and count them as inventory. But if you run out that day, right, you need some kind of way to go ahead and purchase those items, but at the same time, you may need to make those minor business expenses that same day. And you can't go through the purchasing order because it's going to take anywhere from 2 to 3 days or a whole week for you to be able to receive your orders. So in this case, right, this petty cash is meant for minor expenses that you may have to incur, all right? Especially like if you're ordering things and you have it on COD, right, cash on delivery, right? And if your boss is not in the office, right, you may have to need some money so you could pay the delivery guy to drop off all this stuff for you, okay? So those are just examples of what minor expenses can be, right? What I'm going to show you today is what we're going to be using the petty cash drawer for is if you want to have it for minor expenses, great. But another example that we also want to look at is a cash register, because a cash register kind of functions exactly like a petty cash drawer, okay? Now, there are two features of a petty cash drawer, right? You actually need a physical lockbox. You don't want to have a money bag just stored away in some drawer and call that a petty cash box. No. Anybody can open that drawer, find money, and be like, whoa, where does this money come from? And they can steal it. You want to have some kind of safe way to secure your money. So it has to be a lockbox with some kind of key or some kind of code, right? And someone needs to be in charge of it, all right? Second thing is you need to create a ledger account, all right? When you create this ledger account, what happens is that whoever is going to be in charge of this petty cash drawer, right? They're going to be logging in who took money, what amount did they take money, and did they bring back the receipt with the exact change, okay? So make sure that you are aware of that. Now, oftentimes you can use the petty cash drawer as a reimbursement. I've seen that before, right? Where people use their own credit cards and they come up to the petty cash and say, hey, here's my receipt. This is exactly what I bought. So what they do is they take that receipt and they reimburse them. Or they go up to the boss and they issue a reimbursement check, right? So a petty cash drawer can do a lot of things, right? But the main idea is that your cash box should always have cash in it, all right? And if you take money out from it, you always have to have the cash receipts or the receipt of proof that a transaction has happened, all right? That's the most important thing about a petty cash drawer is that at the end of the day or at the beginning of the day, you're going to start with some cash in the box, right? Let's say we have $500, right? The value in the cash box, whether you take money out and put receipts in it, should always hold the total of $500, right? And then once we reach the end where we're low on cash in the petty cash drawer, that's where you need to reimburse the petty cash drawer, okay? So that's just a few examples that I want to go ahead and talk to you about, and we're going to go ahead and dive in on an example right here, okay? So first, we're going to talk about how we establish a petty cash drawer, right? The idea is that we need a physical lockbox, and second thing is we need to create a ledger account. Now, if you guys remember what a ledger is, right, I'm talking about the general ledger. We need to create a general ledger account for one reason and one reason only. So you know how much cash should be in the petty cash drawer at all times. So if you guys remember, what the general ledger does is it's a list of every single account that exists in your business, and it has the running balance. So that's why it's very important that you have a ledger account in your chart of accounts for you to go ahead and proceed with your petty cash drawer, right? You never want to write a check to the petty cash only to say I didn't have a place to record it for you to basically have that money disappear. Okay?
I have a question.
Go for it.
Isn't the general ledger account replaced with replaced by the voucher register? There's no longer a general ledger account.
What do you mean by that?
Um, the using the general ledger account is not we doesn't it get replaced by a voucher account? It's not called the general ledger anymore.
No, no, no. It's still called the general ledger.
Okay, and it says you should remember the cash payment journal and the purchase journal are replaced by the voucher register and the check register, while the subsidiary account payable ledger is replaced by the unpaid and paid voucher files. So we no longer use the words general ledger, right?
No.
Because it's replaced with another name, the voucher account.
Okay, so in this case, maybe somewhere for maybe smaller businesses, but I if you apply for a job, there is such things as general ledger accountant. Yes.
Right.
I mean, words could be interchanged, but as far as this, general ledger still exists, right? We talk about it in QuickBooks in 2021. It still exists. There's no replacement or anything like that. General ledger still exists.
Journal and the purchase journal are replaced by the voucher register. It's on page 220 of the accounting book.
Okay, so that is when we're talking about
I'm
petty
sorry,
cash.
230.
That's when we talk about petty cash because when we're talking
Isn't that what
about,
we're talking about?
yes.
Petty cash?
Oh, I thought you were talking about in general terms. Like, does general ledger exist? It Yes, it does
Oh
exist.
no, yeah, of course it exists, yes.
So
But I'm
yes,
saying we would no longer use those terms. General ledger, we would use a different term, which is the payment journal or the purchase journal, right?
yes.
Okay.
But again, that's when we get into more complex type of accounting. But I'm just telling, this is just basic information. This is basic accounting. This is the 101. Now, when we talk about the general ledger account, right, we're just talking about the ledger itself, which just holds all of the accounts and account information with their account balances. That's what I'm talking about here.
Okay, I understand.
Okay. Now, when we talk about purchasing journals and inventory journals, okay, those are going to be something that's going to go way out in there. Now, vouchers, okay, so if we're talking about petty cash, yes, when we talk about petty cash, right, you will be receiving a voucher, right? And that's what you have to come back with when you let people borrow money, okay, from the petty cash drawer. But first, let's talk about establishing it first, and then we'll talk about how the money is being used from the petty cash drawer, okay? So first thing first here is that we need to establish a petty cash drawer, right? So as we mentioned before, right, we need a physical lockbox and we need to create a general ledger account for the petty cash, okay? So once we've done that, so here on January 5th, right, you establish your petty cash to be a total of $500. Now, how do you do that? You're going to debit your petty cash, right? But you're going to credit your checking account. So in this sense, right, you have two options, right? You can actually go to the physical bank and, withdraw money and place it into your petty cash drawer, right? But most way that you definitely want to make sure that you do keep track of the transaction is you actually would write a check to the person who's in charge of the petty cash drawer. they themselves would cash it out, and they themselves have to put the money into the petty cash. Okay, and then whoever the person who's doing the accounting is going to record that now we have some money into the petty cash drawer. Okay, so that's the very first thing you do. This is how we establish a petty cash drawer. Okay, now for any reason, right? So here is where an example for a ledger account is that, well, on January 5th, I decided to open up my petty cash drawer. So I'm going to make sure I make a note because I journalized it, right? So therefore, the next step I have to do is I must post it to the general ledger so I know how much money I should have in my petty cash drawer at all times. So here you go. I journalized it here, or I would post it to my ledger, saying that on January 5th, I opened or I established my petty cash drawer to be at a grand total of $500 at all times. Okay. So then, how do we actually spend the money in the petty cash drawer? Okay. So what often happens is because we have someone who's managing or someone who's in charge of the petty cash drawer or the lockbox, right? This is where they need to have a separate little ledger for themselves, right? So it's to them, that's where, if you're talking in terms of petty cash and you're talking about vouchers, this is what this part is that they have their own miniature ledger account that they, in terms, use as a voucher system, okay? So, of course, in here, I don't mention it as that type of terminology because sometimes that's confusing to understand. I understand it is that when you have someone who's in charge of the petty cash drawer, you must have or provide them some kind of way to record who is using the cash, what is the reason why they're using the cash, and for what reason, and if they return the cash receipt back. All right, and with that idea, so that means at the end of the day, no matter what we are looking at, when you take money away from the petty cash drawer, you are expected the person who you gave the money for them to lend out with the voucher, they must come back with you with that same exact voucher with the receipt and the exact change. All right, and you place it back into the petty cash drawer. Okay, so in this case, right, when we record this transaction, we do not record it until the very end, okay? Because the lockbox, once again, it's to accumulate all of the receipts until we one day, when our lockbox and petty cash drawer is low, that's when we take all the receipts out, we record all those transactions, and then we reimburse and replenish the petty cash drawer. Okay. So how does that work? So once again, here is an example. They get their own petty cash drawer ledger, okay? So this is separate from what a general ledger account is, okay? This is some kind of card or some kind of form that the manager of the petty cash drawer must fill out. So that means if someone comes up to you and says, hey, I need to borrow some money from the petty cash drawer to purchase some of these things, then that's where they're going to write your name, right? So for example, on January 10, Sam, right? They decided to borrow some money because we had a meeting. They need to buy some meeting supplies. So that's what the expense is going to be for. They took from the petty cash drawer $25. So what they're going to do is they're going to write on a voucher, give the money with $25 with that voucher, and at the end of the day, Sam must come back to you with the voucher of whatever they purchased. They must give you the receipt with the exact change. So that means the receipt should say, okay, $23.85 they must give you exact change of $1.15. And what you're going to do is you're going to place that back into the petty cash drawer. And what you're going to do is you're going to run your balance, because you need to have a running balance to know how much cash you actually have in your petty cash drawer. But at the end of the day, right, as we mentioned before, once you keep releasing all the money, all those vouchers go out to those people and they bring it back to you, right? At the end of the day, your balance of total receipts plus the cash that's left over in the box should be equal to the total amount that you started your petty cash drawer with. So in this case, right, $443.18 worth of receipts plus $56.82 of cash left remaining in the petty cash drawer should equal up to $500, which is what you establish your petty cash drawer to be. That's the money that you started out with your petty cash with. Okay? So, Kim, I think this is what you were talking about. This is the, okay, so in this case, this is a different terminology for the ledger, right? When we're looking at the petty cash drawer, we don't call this as the ledger, right? I say it's the ledger because the definition of a ledger is to keep a running balance of every single account. In this case, you're right. This one is going to be considered the voucher because they're receiving vouchers for you to borrow money from the company, and their job is to come back, return the voucher with the receipt and the exact change, and you're going to update, in this case, the register or their ledger. Okay?
Okay, got it. Thanks.
So again, the petty cash drawer has this right here that allows you to keep track of the money that people borrow, why they borrowed the money, and how much did they borrow. Okay? And you're going to create a running balance so you yourself can check the petty cash drawer to make sure, well, do you have enough for them to give them? And if you're running low, if you only have $56 left in your petty cash drawer, you tell them, I'm sorry. If you're going to purchase something, you either go buy it on your own credit card and request a reimbursement check, or you can take the $56 that is left in this petty cash drawer and buy what you can. Okay, so it's good to make sure that you have this as the petty cash drawer manager has this, so they can keep track of the money that's in the petty cash drawer. So as mentioned before, right, we will keep recording this, right? This is the petty cash drawer manager's job, is to keep track of the transaction and where the money goes. However, we do not record this in the actual books. Okay? Now, when do we actually do it? Is going to be when we actually begin to replenish the petty cash drawer. So as mentioned before, right, we took a look here, right? I only have $56 left, $56.82 left in my petty cash drawer. Now, with that being said, right, that's not enough for me to carry on to the next month. I need to replenish it. So then when I start my next month of transactions, right, my petty cash drawer is at 500. So what you're going to do is you're going to record all of the transactions. So all the expenses that you incur with all of those receipts. So you can categorize them based on, right, we labeled them already. We labeled them on which expense that they have encountered, right? So Sam bought some meeting supplies, right? John bought some printer ink, all right? Katie bought some grand opening party supplies, okay? Anything like that, right? And we would have to put in our books what these transactions mean, right? So obviously, printer ink could be an office supply expense, right? And then obviously the grand opening party supplies or the meeting supplies could be just a regular business expense. Okay? So once again, all of these are going to be recategorized to what appropriate expense accounts they belong to. So in this case, you're going to now journalize them into your books, okay? You're going to recognize that these transactions have occurred, right, by taking the receipts and placing them in their proper expense accounts, right? And what you're going to do is basically what you're going to take all of those receipts from the petty cash drawer. You're going to count them all up, right? Which we know to be a total of $443.18 because the person, the petty cash drawer manager, had already calculated for us, right? So we already know how much we need to place back into the petty cash drawer, right? So what we're going to do is we're going to write the check for the total amount of receipts that you have collected. Okay? So in this case, right, we have a total receipts in our cash box and $56 of actual physical cash in there. And what we're going to do is we're going to take the receipts of the $443 worth of receipts and we're going to convert them into cash by writing another check out for $443.18. And that money is going to be the petty cash drawer is going to be the manager is going to be responsible to go take it to the bank, cash it out because they need to get the exact change. They need to get that exact 18 cents. Bring it back to the office and place it into the petty cash drawer. So then now, for the next month, they have a total of $500 cash in the petty cash drawer. And that's how you replenish the petty cash drawer. You do not directly debit or credit the petty cash drawer itself. Okay? Because mine now, I want to make sure that at any single given day, given point in time, my petty cash drawer should reflect a total of $500, no more, no less. Because that's what I established the petty cash drawer to be. And because I'm taking my receipts and I'm writing a check out, your only responsibility is for the petty cash drawer manager is they cash that check out and place that money back into the petty cash drawer. So in this sense, right, when we journalize our transaction, we're taking the receipts from the box and we're converting it back into cash. Okay? Right? All right, so go for it.
Okay, so when we establish the petty cash, do we create a general ledger number for the petty cash?
Yes, so here we need to create a general ledger account. So if you remember what a general ledger is, right? It's the list of every account that you use in your business. So you need to create this account, okay? And then you're going to journalize it and post it to the ledger so you know how much money you should have in the petty cash drawer at all times. Okay?
And so once we count all the receipts, that's when we are going to assign the debits and to whatever, like you said, business expense and all this. Because I was looking at it and that's what I was getting confused. I'm like, okay, so party supplies is not business supplies. So that's when you put it on their business expense because it's a little bit too general.
Right. So again, like when the person who's in charge of the petty cash drawer, right? The person says, "Hey, I'm gonna go buy coffee for a meeting." You can write right on here that it's coffee for the meeting. Now again, this person isn't the person that's in charge of the journal or the general ledger. The bookkeeper is, right? So what's going to happen is this little petty cash drawer manager is going to give this card or this voucher to the bookkeeper, and the bookkeeper is going to take a look at these transactions that happened, right? And they're going to take that and they're going to separate these transactions, right? So for the first one is meeting supplies, right? Well, I can create a business expense called business events expense instead of party supplies expense. Or I can treat it as a meals and beverages expense. Okay? So once again, right? When we identify this, obviously the person who's the petty cash drawer manager, they're not going to know what the general ledger looks like. They're not going to know what the accounting information or what the bookkeeper knows, right? Because they're not in charge of that. All they're in charge is, okay, you're going to buy coffee for a meeting. All right, I'm going to write that you're buying coffee for the meeting. Where now when the bookkeeper receives this, they have to convert these transactions into the accounts that exist in the books. So in this case, right, someone bought coffee for, or in this case, they bought staff meeting, right? They bought coffee, right? Coffee and bagels, right? That's going to be considered meals and beverages expense because that's an expense from the company that they're providing for the meeting, right?
And that would depend on the company if they only want like actual business meetings with vendors or customers, or if they also consider that a business expense or a meeting expense, right?
Absolutely correct, right? Every general ledger and every general account is going to have their own chart of accounts on how they want to separate their expenses. So in this case, I'm just showing you an example of what happens when someone who's just in charge of the petty cash drawer just writes down they're buying coffee, translating it in bookkeeping terms, right?
Mm-hmm.
That's going to definitely be a meals and beverages expense.
And that's what it was confusing me because based on my experience, it was only if you had a meeting with a customer or a vendor that was considered a business expense. But
Mm-hmm.
anything that we bought for the office or the staff, it wasn't considered a these meals and beverages expense.
It
But
depends.
thank you for the explanation.
It also depends on the company too. If you're having a staff meeting and you're hosting it at 8 o'clock and you don't serve coffee or anything,
Mhm.
I mean, kind of, your employees are gonna
Yeah.
be kind of like, you pulled me into a staff meeting. Of course you don't expect anything, but that's always general courtesy for the boss to go ahead and provide for them. So it could be
Right.
something like that. It really depends on the company.
On the count. Okay. Thank you very
Absolutely.
much.
So once again, if they bought coffee for the company, here you go. It's now considered a meals and beverages expense, right? So there we have it, right? So as far as this, when you use the money in the petty cash drawer, you are not to record it until you are going to replenish the petty cash fund. Okay? No dipping into petty cash account. You're not going to journalize it there whatsoever, okay? You only use the petty cash account if you want to either establish a petty cash fund or for in this instance, right? I was only left with $56 in my petty cash drawer, right? That's definitely pretty low. That means my January expenses was pretty close. Meaning maybe $500 is not enough. So now, if I want to increase my petty cash drawer, let's say I want to make sure that now instead of having it at $500, I want to increase it by $250. So then my total amount in my petty cash drawer is now $750. Okay? So here, all I do is now if I want to increase or if I want to decrease my petty cash drawer, then I can directly journalize petty cash in my checking. Okay? And what we're going to do is we're going to now place into our ledger. So then now, because right now my petty cash drawer should hold $500, because I'm increasing it by $250, therefore I should have a grand total of $750 in my petty cash drawer at all times. So this is how a general ledger works, but this is how we increase or decrease in an account, right? So in this case, right, I established at 500. Now I journalized it by increasing it by $250. So then now in my ledger, it tells me that now I should have a total of $750 in my petty cash drawer. Okay? So that's what I mean by don't be using the petty cash drawer directly or the petty cash account directly because that's telling me that I'm trying to increase or decrease my account. If I'm trying to spend the money in the petty cash drawer All I do is just spend whatever's there and I replenish it. That's how I record the transaction. Okay. So once again, now that I it increased it, right? So in this case, this is just another example for February's transaction, right? I now have a total of all of these transactions that just has happened, right? Maybe I had another business meeting again on what is it? In February. So there you go. In this case, I didn't change them. I just left them the way it is. Because maybe in this case, the person, they just were too lazy to place everything in the proper expense account. But in this case, I also didn't show you what happened in the petty cash drawer manager. So in this case, it's just an example of what happens when you do have another transaction where we filled the money up. We filled the petty cash drawer to now to be $750. Now then, once again, now that the month is over and we see that we need to replenish the petty cash drawer, this is how we do it. We're going to recognize each expense that occurred, and we're going to write a check for the total amount of receipts, and we're going to place this $178 back into the petty cash drawer. Simple and easy as that. Okay. Any questions in regards to petty cash?
No.
So
No.
Okay.
I have a question.
Yes.
So at the end of the year, can we claim it for tax expenses?
It depends on what it is. If you're a small business, yeah, it depends because once again, if you in the business are one, if you're a sole proprietor, instead of taking taxes off the business, yes, you can write off these business taxes, and you can also write it off of your personal taxes because you and the owner are one. Now, yes, it just depends on what the circumstances is. If, for example, right, if these business expenses are necessary, then according to the IRS, you have to fill out that long form for the business and you're going to claim those expenses. So it depends on what the expense is and how much you're claiming and what you're claiming it for. So again, that's an IRS thing, and that's definitely something you're going to have to learn further on in the future if you tend to pursue taxation type of accounting.
Yeah, none of these things are write-offs now for taxes
Okay.
with your business. You can't buy donuts and stuff for your employees. All that is not tax deductible for the businesses anymore.
Okay.
Okay. Okay. In general, petty cash is not tax expense at all.
No. Petty cash is just for minor expenses. If the boss isn't there to write out your check for you, right? This is a second place that you can come and get your money. Now, a lot of oftentimes what more people commonly do is, oh, um, I have to run and go get coffee and bagels for the meeting. They'll charge their own personal credit card, and they go to they bring the receipt, and basically they just tell the boss, I like to have a reimbursement check reissued to me. Right? So in this case, yes, the boss should reimburse you for any expenses that isn't personally yours. If it's for the company, the boss should hold responsible to pay for those expenses, especially if it's a communal, it's for the whole community or the whole company or for the whole business itself. If you're providing donuts, you don't want to pocket that out of your own pocket, right? You want to be reimbursed for that. But sometimes some people are like, well, this meeting's mine, right? This is because I'm doing a presentation, so I'm going to provide coffee and donuts on me. It just depends on what the situation is. But in most cases, a lot of the times, you should be reimbursed for any business expense that isn't a personal expense. If you're providing for the company, the boss should be responsible to reimburse you for that. And that's what's more common. So that's why sometimes the petty cash right now doesn't cease to exist, right? Because we have business credit cards now, right? Same idea here. If you're going to have the business credit card, right? you can use the petty cash drawer with the business credit card, and obviously it's the same idea there, right? You have someone record that they're borrowing the business credit card. They must come back with it with the receipt, and obviously the expenses is going to be recategorized when they take a look at their credit card statement. Okay, but in this case, this is just in case, like, again, when you're a smaller business and you need these small, minor chunk change for a reason. Okay. Now, for any reason that you decide that you no longer need a petty cash drawer, this is where you're going to choose to close it out. And that's what I mentioned before. Oftentimes, right, if for some reason your company decides keeping track of this is not good, it's not very productive, then, or if you guys decide to use a business credit card instead, so allow anybody have access to it, as long as they have the credit card, right? And as long as they have the receipt, then, you could close out your petty cash drawer. How do we close it out? Pretty straightforward, right? We obviously going to take all the money in the petty cash drawer and we're going to dump it into the bank. That's rule of thumb, right? Pretty straightforward. You don't want to take that money and put it in your pocket. That money goes straight to the bank account. Okay? And of course, you're going to credit your petty cash drawer because you no longer have it. So if you're gonna close it out completely, you're gonna zero out the account by writing out how much the balance should be in your petty cash drawer for. So in this case, right, because I established it at 500, I increased it by 250, therefore I have to close it out at 750. Okay, and once you close it out, you also got to close it out into your general ledger as well, saying, well, by June 1st, right, I no longer need to use my petty cash drawer. So here it is. I closed it out, which I credited my account for $750. So therefore, my petty cash drawer holds $0. Okay? That one's pretty straightforward. So the only means to use the petty cash account is if you are going to establish, increase, decrease, or close out the account. Okay? You are never going to use it when you're using the actual money in the petty cash drawer. Okay? Any questions there?
No.
Okay? So now that we took a look at a petty cash drawer, right? A common characteristic or a common example would be a cash register. That is, okay, if not, I'm pretty sure about 95% of businesses, right, they have a cash register. So that's why one trying to think, if you can't relate to a petty cash drawer, then you can definitely relate to a cash register, okay? Because 95% of companies, all types of businesses that are retail, should have a cash register, okay? And once again, same thing here. It has two key features. Number one is you have a physical lockbox, right? In this case, an actual cash register, right? It should have a key to it, et cetera, et cetera. And you also need to create a general ledger account because at the end of the day, right, this is your money. This is the money that you're accepting. This is the money that you are responsible to collect for your sales. This needs to happen. You have to have a ledger account. Okay? And you always, if you ever been into retail, right, and you are the person who operates the cash register, always at the very beginning, before you open up your store, they always require you to open up the cash register, count how much money you have in the very, very beginning, so you know how much money you have in your cash register when you start the day. Because at the end of the day, what you're going to do is you're going to have a wad of cash, right? And what you're going to do is you're going to subtract it out, and it must match the total number of cash receipts or cash sale receipts. And that's the same similar idea. The only difference here is that you're not using the money for expenses. In fact, the money that's in your cash register must hold its amount at all times, but you're also getting more money because people are paying you for goods and services. So in this case, it seems like your cash register is increasing, but that's not true. That's just the money that you're receiving for sales. So in this idea, right, the idea is that your cash register should have the cash that you started out in the very beginning of the day, right? And then when you count your cash receipts and you count the cash that you have in your cash register, you're going to subtract out what you started out with, and your cash receipts should match your register at all times. So that's the idea here. This is the only similar example that I can say that is similar to a petty cash drawer, but the only difference is you're not using the cash for expenses. You're only using it to collect cash from sales. Okay. So in this case, you can treat a cash register exactly like a petty cash drawer because you have the same idea. You're going to need to establish it. The way you increase it, decrease it, and the way that you close out your cash register is the same. Okay? So here, right, if I need to establish my cash register, right, if I say, okay, on January 5th, I'm going to establish my cash register to have at least $500 in my register at all times. So that when I have my cash customers, right, I can, give them their proper change for their goods and services, right? Of course, ideally, you want to make sure that you have enough like dollar bills, tens, usually smaller change is what is ideal. Okay, you're going to make sure that it's counted to the total amount that you want to start your cash drawer with. Now, $500 is pretty good for a first day because you never know how the day is going to go. Okay, so there you go. I established just exactly the same as you doing a petty cash drawer. You're going to go ahead and open up your cash register account. Okay. And here I'm going to journalize saying that my cash register should have $500 at all times in the cash register. Okay. Then let's say I need to replenish my cash register. Is pretty straightforward, right? There is no need for an entry because we're not reimbursing the amount of cash in the ledger, or in this case, the cash register, right? The only normal thing that you would do is you would just exchange the money so then you have enough smaller bills to have in your register at all times. But once again, your idea here is that you're going to count the total number of receipts of your cash sales receipts, right? You're going to count the money that's in the register. You're going to subtract what you began the cash register with, and then your total receipts should match your total extra cash that you have in the register. All right? So once that happens and then they pan out, right? Then at all times your cash register should still remain with the $500 that you started out with. And that's what this is. When you're replenishing a cash register, you don't need to do anything here at all because you're not reimbursing the register. You're not filling it up with more money. In fact, you're just exchanging the money because you're going to be low on the smaller bills. So in this case, that's why they're similar in concept on establishing, but in this case, the only difference is you don't need to replenish it. Okay? So once business picks up and you're noticing that every time you have your customers, you're slowly running out of money or running out of smaller change to exchange with your customer. So what often happens is that in time, you're going to always frequently increase your cash register at all times. Now, this is also a possible reason why you should have a petty cash drawer on the side for in case you need to exchange some money to get some loose change so you can have it for your customers so you can provide them the exact change. Now, oftentimes, right, oftentimes when you do start a cash register, you just have to feel for how many customers come in your store and how many of them are going to be charged on a cash, how much are going to be charged on a credit card, etc., etc. So in this case, right, in this case, I have my business is picking up, so now I need to establish and increase it by $250. So once again, you're going to update your ledger. So now your cash register should hold $750 worth of cash at all times. Okay. Once again, and for any reason that you have to, we don't need to replenish it, right? You just need to count your receipts and make sure that they match and make sure that you have enough in your cash register to start your next day. In this case, right, let's say we're going to get rid of the cash register and be strictly only credit only. Okay, or maybe you developed an app where people can come in, they can scan their card, boom, transfer money was over. So for any reason that you need to close out your cash register is identical to the petty cash drawer, right? You're just going to make sure that you take all the money in the cash register, dump it into your checking account because that money's the business money, right? It must go into the checking account. You can't pocket it. And you're going to credit your cash register. And you're going to empty out the cash register. So then now the cash register holds zero money in there. Okay. So once again, the cash register and petty cash is identical to that, to petty cash. So any questions here?
No.
No.
Okay. So now that we discussed that, let's talk about cash shortage and cash overage. So oftentimes, and this happens quite some time too, is that for some reason, when you calculate all of your total receipts and you calculate all the money that's in your petty cash drawer or your cash register, you'll often have either missing money or you'll have too much extra money. Now, oftentimes, a great example is that if you're having a petty cash drawer, right? Oftentimes, the person who borrowed the money never came back to you and gave you the money back, gave you the exact change back. So maybe if their transaction was that they received 11 cents back, it's 11 cents. So the person who took the money was probably like, it's just 11 cents. So they just don't come back to you and give you the 11 cents, or they forgot to give you back the 11 cents. So therefore, your petty cash drawer is going to be short by 11 cents. Okay? Another example of how an overage can happen is that oftentimes your cash customers, right? And we're looking at a cash register, right? They'll talk to you and they'll say, you know what? You can keep the cash. You can keep the change. Then therefore, that is why you would have a cash overage in your cash register, because oftentimes, some people don't think about it, all right, and they just leave the cash in the register, okay? Now, again, there are many methods of what you can do about that, right? You can have a tip jar, and what you do is you take that change, and they say, keep the change, put it in the tip jar. That way, you keep your register and your extra money that's supposed to be kept in the register separate, okay? But oftentimes, once again, it really depends on the given situation and what the scenario is. And oftentimes, you will always see some kind of cash shortage or some kind of cash overage, okay? So let's go ahead and take a look example here, right? So here, right, on June 1st, right, you establish the petty cash to be $600, right? And then at the end of June 30th, right, you decided that you calculated all the receipts. You had a total receipts of $590 and a total cash of and you had zero cash in the register. Okay, so here you have $0 in your cash register, right? And you have a total of $590 of receipts. So therefore, right, if you're supposed to have $600 worth in your petty cash drawer at all times, in this case, I have a cash shortage, right? And what you're going to do is you're going to create an expense account to reflect that you have a cash shortage, because at the end of the day, you need to replenish the petty cash fund for the total of $600, right? Reason being is because you established the petty cash fund at 600, so therefore you must hold a total of $600 at all times in that petty cash drawer. Okay. So once again,
Where do you get the $10 from? Does it come out of the business checking account?
yes, it
Okay.
does. Because once again, the checking account, right? You must have $600 in your petty cash drawer at all times. Now, in this case, right, this cash shortage, right, you could treat it as an expense account or you can treat it as a contra account to the petty cash drawer. Okay? Because in this case, right, you're missing $10. Now, where this $10 go, you're going to have to investigate, or the manager, the petty cash drawer manager must investigate to where this $10 have gone. Right? Maybe the owner decided to come in and take $10 because that was all that's left in the petty cash drawer. He's the owner. He could do whatever he wants. That's his money. So he could come to the petty cash drawer and just be like, okay, you know what? I'm gonna take the money. Obviously, I'm too lazy to write that I took money out. So he could have taken the money. Anything could have happened with this $10, right? So, but in this case, we must record it as usual because in this case, right, we're missing money, right? We calculated the total amount of receipts, but we're missing $10 in the petty cash drawer. So yes, that is going to come directly out from your checking account until you find out where this missing $10 came from. Okay? Simple enough? And
Yes.
okay? And then now we're talking about cash overage. So again, the same example, except this time, right? You counted your receipts. You have a total number of receipts to be 600, but you have a total of $20 left in the petty cash drawer. Where did this $20 come from? We don't know. Maybe the owner decides to swing by and be like, "Oh, I took $10 earlier. I'm just going to dump my change in there because I have 20 bucks in my pocket." Anything can happen with a petty cash drawer. Okay? Or maybe you forgot to record somebody's transaction, or maybe you double recorded someone taking money out. Okay? There are many, many reasons to why you could have extra money in your cash drawer. And in this case, if you do end up having a cash overage, what you're going to do is you're going to leave that $20 in there, right? Even though you're going to record it as a cash overage, right? And you're just going to leave that money in there, and you're going to just replenish the petty cash drawer for the total amount of receipts that you have, which is the $600 minus the $20, so $580. Okay. So that's what you're going to do when you're journalizing and replenishing the petty cash drawer. So again, when you realize that you have a cash shortage or cash overage, it's only when you actually start reimbursing or replenishing the petty cash drawer that you'll find that you have either too less money or too much money in your account. And this is what you do with those extra monies. Okay. You simply just create another, this account could either be an expense account or a contra account to petty cash, whatever you choose, it should reflect. Okay. And that is it for chapter 9. So once again, we talked about what a petty cash drawer does, and a similar example is going to be, once again, a cash register. We looked at how to establish one, how to increase, how to decrease an account, and the biggest one is replenishing the petty cash fund, right? We never directly take it out from the petty cash. We only look at the receipts, determine what expenses that were incurred, and we just write a check for the total amount of receipts there. Okay. Another key factor is that there's 2 characteristics of it. You need a physical lockbox, and you need to create a general ledger account for it. Okay. So that is chapter 9 for you. Okay. Any questions for chapter 9?
No.
No.
Okay. So now that was chapter 9. So we're going to go ahead and take the next 20 minutes to try to go as far as we can with chapter 10.1. Okay. So chapter 10.1, right? Now that we talked about how we receive cash or the process of what cash does to us, right? Now we're going to be talking about receivables. What happens when we allow our customers to owe us on an account? Write us an IOU, okay? And this is where we're going to talk about receivables. So again, chapter 9 was cash, what we do with cash. Now we're talking about what we do with receivables. How do we handle receivables and what happens when we need to encounter bad debt? So let's talk about what a receivable is, right? An accounts receivable is when we allow our customers to owe us money, right? It's another way of a way that a customer signs a contract saying, hey, I will pay you back, right? Later on. It's an IOU, it's a promissory note, whatever you want to treat it as, right? Where you allow your customers to purchase goods and services and allowing them to owe you money. That's what an account receivable is, when you allow them to owe you on an account. Okay? But of course, obviously, before we even give them an account, we run background checks, right? We run their social security number, so on and so forth, so we can see their credit score before we can allow them access or allow them a specific amount that they can owe us, okay? But this is what the definition is for an account receivable, okay? Now, let's talk about what the allowance for doubtful accounts is going to be. Now, okay, so given in circumstances, right, if you're going to be allowing your customers to owe you money, you also have to know that you are also at risk of those customers making faults on their payments, okay? So when you allow your customers to owe you on an account, there are 3 things that you know, right? You obviously need to make sure that when you run their credit score that they're eligible for this credit. But once again, we also have to give to consideration of their circumstances, right? They can have any financial burdens, any financial circumstances that can happen to them at any given moment, at any given time. Okay? So for example, they can file for bankruptcy. Sometimes they can absolutely refuse to even pay you because they said, I don't like you, I don't want to pay you, leave me alone, right? Or they just can't afford to pay you because of their given financial circumstance, right? Anything happened, right? Just like us, right? We came from a pandemic. A lot of us lost our jobs, so we can't afford to pay back for what we owe. So with those given circumstances, this is where the allowance for doubtful accounts come from. It's when your customers decides to come up to you and they tell you about their financial burden, whether they want to release that information or not, or if they choose to just not pay you, then you're going to create a contra account to accounts receivable. And what you're going to do is you're going to remove the amount that they owe you and place it in this placeholder account, okay, for in case one day they do pay you, okay? Because once again, when you're treating the allowance for doubtful accounts, right, they're just telling you right now, I cannot pay you right now. But that doesn't mean they can't pay you again in the future. Now, once again, we'll talk about bad debt in a minute, but when we're dealing with a allowance for doubtful accounts, right, we know exactly who owes us the money, we know exactly how much they owe us, and we know exactly when it happens, okay? Because once again, we send them a bill, they don't pay us, we know exactly when what happened. Because one, we sent them a bill. We know exactly who we sent the bill to. We also report to how much they owe us. And second thing is we know exactly when we issued that bill. Now, if we find that they are not paying us back or they skipped a payment, Now then we are responsible to contact them and ask them, hey, what's going on? Why did you miss a payment, right? For most cases, right? Oftentimes is a lot of businesses, they won't contact you. They'll just tack on a late fee, right? And then you're responsible to tell the company why you have these financial burdens. Okay? It's your responsibility to let your business know that, hey, I can't pay you because of this reason. And oftentimes they'll give you some kind of forgiveness or they'll waiver the fee. But once again, if it's the third or fourth, or you keep sending them bills and you keep charging them late fees and they're just not giving you that, they're not giving money to you because they owe it to you, right? That's when you can be like, okay, I'm going to go ahead and take the amount that they owe me. I'm going to place it in the placeholder account called the allowance for doubtful accounts, right? There's many different terminologies for this one, right? It could be doubtful accounts. It could be allowance for doubtful bad debt, right? Or bad debt allowance. It could be anything, right? But in this case, just the general account that I'm going to be using for this class is going to be the allowance for doubtful accounts, because we know exactly who, we know exactly how much, and we know exactly when it happened. So this account is going to be used during the given period, okay? When we allow our customers to owe us money and they decide to fault on our payment. So this is how we keep track of our customers, and if they don't pay us back, right, then we have to go and harass them, right? We got to call them, send them letters, asking them why we can't get our money back, right? We must exhaust our means to get our money back because we sold them a product, right? And we are expected them to pay us back for the product that we sold to them. Because they wrote an IOU saying, I promise to pay you back. Okay? So that's what the allowance for doubtful accounts comes from. Okay? Now for this given example here, right? So here on December 16, okay, Mr. Sanchez decides that he bought $100 worth of toys on an account, and he pays $20 every month. So he signed up a payment plan, right? We allow him with no financial, interest or anything like that. We just made a payment plan for them. So in this case, right, so then we expect them to pay us back $20 every single month until he reaches $100. So in this case, in January, he paid us $20. February, he paid us $20. Then on March 20th, he decided that he files for bankruptcy and can no longer pay us, right? Because he called us and said, hey, I can no longer pay. I filed for bankruptcy. So therefore, I can no longer pay for what I owe. So in this case, right, what we're going to do is we're going to journalize the first things. First we need to represent that he owes me money. So here, I said that he purchased 100 toys on an account. So therefore, I have accounts receivable and I have the sales for the $100 worth of toys. Okay. Now, of course, I would record my payments as I go through it, right? So January, okay, he made a payment. February, he made a payment. Now that I realize that now it's March, fast forward, it's March now, and he decides to say he filed for bankruptcy, right? So if he's paid me a total of $40, right, from what he owes me now $60 left on his account. But now that he told me he filed for bankruptcy, therefore he can't pay me anymore, I'm going to go ahead and put it in the placeholder, because in this case, just because you filed for bankruptcy, that does not mean he can't ever pay you ever. He still can technically pay you. Okay, so in this case, right, I'm going to place it in my placeholder account. I'm going to transfer the money that he owes me for the $60, and I'm going to replace it in my contra account for the allowance for doubtful accounts. Okay, so therefore, I am going to leave it in here because he still has a possibility to make a payment to me. Okay? So that's what you do when you know who, you know exactly when, and you know exactly how much they owe you, okay? Any questions in regards to the allowance for doubtful accounts?
No.
Okay. So when we decide to exhaust all of our means to try to collect the money that customers owe us, right? Then now we are introduced to what's called bad debt. Now this happens at the end of a given period, right? Because at the end of the year, you are going to create what's called an estimated amount. Because at the end of the year, right, your assumption is that if you decide that you are allowing your customers to owe you money, you are assuming that you are at risk because not everybody will pay you. So in this case, right, when we talk about bad debt expense, right, it happens at the end of a given period. It's in an adjustment entry. Now, what this adjustment entry is that when we are looking at any type of business, right, according to the IRS, you can only write off up to 5% of bad debt. Okay? Especially if you know your customers, right? Like once I mentioned again, you can't trust your customers to owe you to owe you this money to make sure that they can guarantee to pay you off. Especially when we have given circumstances, right? Every person has a different financial circumstance, right? Some person could have got laid off 1 month. Another person could be short on their payments, or maybe they fell sick so they didn't work, so they can't pay you off. They must wait another month before they can pay you back. Every individual that you allow to owe you money has their own financial burdens, financial circumstances. So therefore, your job as a business is that you are only allowed up to 5% to write off these bad debt expenses. Your assumption here is that because you're allowing your customers to owe you on an account, you're also accepting that potentially 5% of those people are not going to pay you back. So therefore, your assumption is that you need to adjust your books accordingly because you have accounts receivable. Therefore, the IRS allows all businesses up to 5% to claim as a loss and not be penalized for it. Okay, let me mention that again. IRS allows you to only write off up to 5% of receivables that you know that you're not going to be able to collect. Okay? Now, here's the difference. If the government allows me to write off how much I can take away from my customers, right? Because I know that all of my customers are not going to pay me back. Here's three things that you don't know. You obviously don't know who's not going to pay you back, right? You're not going to know who. Out of 1 billion customers that you allow to have on an account, are you going to know exactly every single person's circumstances, financial burdens? Are you going to know every single one of them? No, you're not. Because your main business isn't to collect money from them. Your main business is to sell products to them. So therefore, when you make your estimated amount, you're not going to know who. And you're absolutely not going to know how much because anybody can fault you on the payment. Every person that owes you money, it's not going to be the same, right? Especially if you're looking at a major business, let's say, for example, Walmart, right? They allow their customers a Walmart credit card, right? This person can owe me 10,000, this person can owe me 5,000, this person can only owe me 500. You do not know how much people are going to owe you, and you don't know how much they're going to fault you on. Right? So therefore, that is exactly why how you wouldn't know how much, and that's why you need to create a rough estimate where 5% of total sales or 5% of your account receivables is usually what's going to be your determining factor here. That's going to be your estimated amount. Okay? And then again, when, of course, you don't know your customers' lives. You don't know when they're going to fault their payments. You don't know when they're going to not pay you, or if they do choose to pay you, they'll pay you more. You do not know when you will not receive this money. So here's the difference between the allowance for doubtful accounts and the bad debt expense. Okay? Bad debt expense is going to be something that you're going to generate out of thin air, right? And this is what you're going to report to the IRS, that you're going to be taking a loss. And the IRS only allows you to take up to 5% of accounts receivable losses. Because once again, you have a billion customers, you can't trust all billion customers that they're going to pay you back. And that's the dangers of doing business, especially if you're allowing them to owe you money. So once again, when we talk about Walmart, right? If majority of their customers are credit-based customers, right? And you actually run a report on them. Now, and just because you sold a product to them, in other people's eyes, it looks like, wow, your company's so profitable. But let's actually bring it back down and see how much of those sales were actually cash. How much cash did you actually receive from them versus all the people that you allow people to owe you for? Then you're going to take a look at that and be like, wow, you really didn't even make any money, because all these people owe you the money and you have a potential that they may not ever pay you. So that's the dangers of doing business, especially when you're running on an account receivable. You must assume, and this is why a lot of corporations pay the big bucks to have debt collectors do this for them. Okay? They're the ones that are going to be what they call it is that they sell their accounts receivable, right? Or they sell their accounts to debt collectors, so they are responsible for trying to collect the money for them. And that's, again, another topic for another day. So once again, when we look at utilizing the bad debt expense account, it's when, one, we don't know who, we don't know when, and we don't know how much. So this is where we're going to make an estimated amount, and this usually happens at the end of a given period, right? And typically this happens at the end of the year. But of course, you could also do a month-to-month basis, especially for like major corporations such as like Walmart. They would probably do it every quarterly just because they're a billion-dollar company. They lend a billion people money so they could buy the products at Walmart. So that's exactly why they should keep more track of this, because they are subject to have more commonly people fault on their payments, and especially on a month-to-month basis. That way, instead of waiting till the end of the year to calculate how much money they're going to be writing off as a loss, they could do it on a month-to-month basis, because they can keep their track of their customers a lot easier. Okay? So this is what happens when we look at the allowance method. There are two ways to use the bad debt. Sorry, excuse me, I said allowance method. To write off bad debt. Okay? There's one where you're writing it directly off from your accounts receivable. And that's a big no-no, because this class we are bookkeepers. We are not certified tax accountants. So therefore, we cannot write off the bad debt, or in this case, write off my loss directly off my accounts receivable. So in this case, that one's called the direct write-off, right? You're directly writing off the money from your accounts receivable. And we are not allowed to do that because we're not certified tax accountants. This is only for tax accountants and for IRS tax purposes only. But as a bookkeeper, this is the necessary procedures that we must do, which is called the allowance method. And it's broken into two ways that we have to calculate this, okay? It's broken into the income statement method, and it's broken into the balance sheet method, okay? So in this case, right, and this is governed by the Acct. The rules of Acct tells us that, hey, you are not a tax accountant. If you're not a tax accountant, this is what you need to take the steps in order to be able to properly write off the bad debt properly, okay? So in this case, we are not going to be teaching you the direct write-off method. However, what I want you to do is I want you to at least know that it exists and why it exists, okay? It's to write off bad debt directly off of the accounts receivable, okay? And it's for IRS purposes only, and it's only used for tax accountants, okay? We are going to be focusing on the allowance method, okay? So there's two ways that we can write off bad debt, okay? So let's talk about the balance sheet method first, okay? Balance sheet method, there are a few criteria that you need to know, okay? So this is just a way that you are able to, exercise this. So instead of having to understand the logistics of why you're doing it, you could just memorize how to do it. All right, and this generally is just much more easier, okay? So when we're looking at bad debt, right, when we transfer it, like during the period, right, when we're transferring it into the allowance or doubtful accounts, that is the reason why we have an account balance in the allowance for doubtful accounts. Now, when you reach the end of a given period and you're realizing that this person who still owed me money isn't paying me back, and it's been so or so many months, that's where we can assume, okay, well then he's going to be placed in the pile of my estimated amount that I'm going to write off because I'm never going to collect this money from this person. I'm going to write him off as a loss, okay? So that's why we have a balance in the allowance for doubtful accounts. Now, here's the difference, right? When we're looking at the balance sheet method, right? We're looking at the balance sheet itself. Now, let's take a look at the scenario real quick, right? It's telling me that that the estimated $25,000 of its $500,000 accounts receivable is to be uncollectible. And right now, there's currently a debit balance of $5,000 in the allowance or doubtful accounts. Journalize this transaction, right? So that's the scenario here, right? Now, why are we talking about the balance sheet method? Well, let's take a look. When we run our balance sheet method, right, it's basically we're running to test the accounting equation. So we're going to list out all of our assets, we're going to list out all of our liabilities and our equity, right? So in this case, right, the reason why this is called the balance sheet method is because when we produce our balance sheet, one thing that we see is we recognize accounts receivable. And we should also recognize that if you have an allowance for doubtful accounts, that appears on the balance sheet. So this is very, very, very important that you know this because it does appear on this is the necessary steps that you need to take. So at the very top of the right corner, right, this is what we're going to take a look at. When we read the scenario, we need to recognize what the estimated amount is. In this case, it's telling me that $25,000 out of my $500,000 of accounts receivable. Okay, so that means people owe me a grand total of $500,000. Right? 5% of $500,000 is $25,000. Okay. So now that I'm recognizing, well, realistically, 25,000 of those accounts receivable dollars, I'm not going to ever collect ever again. Okay. Now, once we establish that the estimated amount is $25,000, The next thing that we need to look for is the keyword accounts receivable. Right there, boom, accounts receivable. Now the third thing is that means if we recognize it's accounts receivable, that means the allowance for doubtful accounts matters, okay? Because it appears on the balance sheet. So in this case, right, I have currently a debit balance in my accounts receivable, okay? Now, because we recognize that allowance for doubtful accounts is a contra account to accounts receivable, we know that at the end of the day, since it's decreasing my accounts receivable, it must hold a credit balance. So in this case, if $25,000 of my accounts receivable is to be uncollectible, right? Therefore, and I have currently right now, out of those $500,000, right? I already know that $5,000 of them during the given period was already potentially bad debt. Therefore, I have a debit balance for $5,000. So here's the method here. If I have a debit balance, I'm going to add that the amount, the balance amount to my estimated amount so then that's going to be my total amount that I'm going to write off. If I currently have a credit balance, meaning someone who owed us paid us, right? Therefore, I should have a credit balance in my allowance for doubtful accounts. Therefore, if I already have a credit balance and my end goal is to reach $25,000 in a credit balance, then therefore I subtract my number because I'm already on my credit side. Okay? So in this case, since I have a debit balance, right, I'm going to add my two values together because at the end of the day, what I need to get to is that I need to get $25,000 to reflect in my allowance for doubtful accounts account. Okay? So right now, if I have a debit balance, if I went left 5,000 steps, okay, I need to get to the right side to equal to 25,000. So therefore, I need to backtrack because I'm on the right. I'm on the left side, right? I currently have a debit balance of 5,000. So therefore, to get to zero, I must go 5,000 steps to the left, right? And then I need to go to an additional 25,000 more steps to the left to reflect in my bank account into the ledger account for my allowance for doubtful accounts to reflect an ending total of $25,000. Okay? So therefore 5,000 plus 25,000 is going to get to my grand total of $30,000. Okay? Any questions here?
Can you repeat the math again, please?
Okay, so in this case, right, we're looking at our ledger account. If I've already journalized that I have a current debit balance, I'm on the left side, right? I have $5,000 debit balance in my allowance for doubtful accounts. My end goal here is when I'm looking at the scenario, my estimated amount of $25,000 is what I want to be in my allowance for doubtful accounts balance. I need to reach a credit balance of $25,000. Okay? So if you guys remember our lesson about debits and credits, right? It's like a weighing scale, right? In the middle is zero. Zero means you're evened out. There's no left or right. So in this case, I'm already on the left side, $5,000. Okay. My end goal is I need 25,000 on the right side. So in this case, because I already have a debit balance, right? I need to remove 5,000, or in this case, I need to add 5,000 more plus my 25,000 to make my balance scale reflect that I have 25,000 in my credit side in the allowance for doubtful accounts account.
Okay, thank you.
Okay? Because like a number scale, right? If I'm -5, how do I get to 0?
You would credit 5.
Correct. But in this case, I'm -5 right now. I need to get to +5. How do I get to +5?
You're gonna credit the 5
Plus,
plus the 25.
yes. Okay, or in this case, right?
So,
I'm -5. I need to get to 0, so that's 5. But I need
oh,
to get
okay.
to +5, so I need to add 5 more.
But where's it coming from?
When you,
Out of your doubtful accounts?
yes, that's why my journal says I'm going to debit my bad debt expense, right? And I'm going to credit my allowance for doubtful accounts. So it is coming directly out from your allowance for doubtful accounts. And that's the difference between the allowance method and the direct write-off, because in the direct write-off, I'm directly taking it right off of my accounts receivable. In this case, I'm taking it directly out from my allowance for doubtful accounts.
Excuse me, my dog is crying, and I need to take him to the vet
Mm-hmm.
up the street. Are we? What time do we go on break?
We're gonna go break right now.
Okay.
Yeah, I was
I
just
may, I may be about 4 minutes, 5 minutes late, but I'll be right back.
okay. No worries. All right. So
Okay.
again, we're gonna take a break now. So right now it is 10:20. So go ahead and take your 15-minute break and be back at 10:35.